Oh, look, it's a pretty solid, clean result. And Westpac, unlike most of its peers, is purely an Australasian bank with a very heavy retail focus. And the Australian financial services business actually did really well, up 12% in terms of earnings. Overall, the bank, cash earnings up 8%, and ROE above 16%. It's a very strongly capitalised, so ticks a lot of the boxes about what constitutes a good bank in this environment.
And good numbers compared to at least ANZ, who was out last week. Not quite there where NAB is yet, though, in terms of ROE.
Well, NAB in terms of ROE looks pretty ordinary because of the UK banks, right? So you're talking very low double digits for NAB. Its Australasian businesses, though, do have terrific ROEs, above 17%. So in that sense, it's not quite as good. But remember, Westpac's got the most strongly capitalised balance sheet, which would tend to depress the ROE anyway. So you've got to be careful about the apples and oranges type comparisons. All the major banks are producing really strong results out of their Australasian businesses, despite the fact that it actually is quite competitive. If you look at Westpac, for instance, and it's true across the sector, but Westpac today, obviously, their net interest margin was down 6 basis points, basically from the same period of last year, and that was down 6 basis points from the period 12 months earlier. So there is continuing compression of interest margins, and that relates to competition. That's the only answer to that.
This is them chasing the home loan market, basically.
Chasing a finite amount of demand. Remember, the last year or so, in fact, the last several years, demand for credit has been, in historical terms, very weak in this market. And so while we talk about the housing market being hot, overall demand for credit has been fairly subdued. And so you've got these four majors, all of whom got a lot of capital, all of whom got big balance sheets, chasing a finite amount of demand. And that creates competitive tensions, which is interesting because we're about to get the Murray inquiry report later this month, which everyone expects to say the bank's going to have to hold even more capital, and will probably raise the floor under the risk weightings for housing lending. That'll flow through, one would think, in two ways. One, as Mike Smith's already said, customers will pay more, but that'll be disciplined by the amount of competition in the system. And so you'd assume that shareholders are going to have to wear some of that pain as well. So this might be, in some senses, this round of results is kind of a historically interesting, but Murray could change everything, right? So you'll get a better sense of the system in a year or 18 months' time, post Murray. But you'd assume that the ROEs for the banks, which are all of them, if you exclude UK banks for NAB, are in that sort of high mid-teens level, will come down a bit. You'd assume that the net interest margin will get squeezed a bit further because there will be more competition, and you'd assume customers would pay a little bit more as well. I think the other thing that's worth noting about this round of results too is we've seen this, over the last 3-4 years, really significant improvements in credit quality. So Westpac's result today, there's a $200 million drop in their impairment charges. Now there's a finite level to which they can drop in, zero basically is the best they can achieve, and they're now all down at quite, by historical standards, very, very low levels. No signs of stress, by the way, in terms of the housing loan portfolio. Their 90-day past dues, Westpac's, fell again. So the credit quality at the moment is terrific. Historically, though, it's so far below the norm, you'd assume that at some point it starts to rise again, which again puts pressure on profitability. So there are a lot of things, Murray, the environment, a cycle of bad and doubtful debts that says this might well be as good as it gets.
Stephen Bartholomew, thanks very much.
Thanks, Jackson.